strategist at Jp Morgan Securities. Ria, it's really good to have you back. What are you seeing so far in the earnings season here?
Yes, corporate earnings are very, very strong. As you said, about more than half of the major companies have reported, and sales growth year on year is 15%, and net income growth is 50%. They are stronger than the peer in US and Europe. And we have to remember that this strong growth, earnings growth, was realized under high oil prices. Japan is oil importing company, which means corporate pricing power has become very strong structurally, in my view. And the driver of earnings growth, as you say, is broadening beyond the AI semi. Banks, trading companies, wholesale companies, and machinery, those were also the driver of the earnings growth.
I was going to say, how much of this strength are you seeing across the board at a time when we've discussed the supply chain disruptions, rising costs, and of course, not to mention on the backdrop of everything is also tariff costs still in play at the moment?
Right. So, Japan's price transfer ratio has, under the deflationary economy, has been 50% compared to 89 to 90% in the US. So, and now, start of the 2023, it's jumped up to 70%. And even under the difficult phases in US tariff in 2025 or higher oil prices this year, actually this price transfer ratio down just a bit, like 68 or so. So still higher than 50% in the deflationary economy. So that makes corporate earnings is still strong. We computed EPS impact by higher oil prices this time will be something like 6% point down. But actually, market consensus is continue to upward revision even after this March.
Do businesses themselves understand the strength of their business right now? The issue with Japan has always been cash hoarding, right? Businesses not spending on the future and not paying the salaries of employees, so you can see a virtuous cycle of wage growth as well.
Yes.
Are we seeing that change in mindset?
Yes, loan growth is now 6%, which is record high these days. So, which is this is because of the growth of the corporate appetite to growth investment. It has just started. This is, I think, related with government promotion of growth investment. Corporate governance now focus on how corporates use excess cash in their balance sheet. So, one way is to use for growth investment. Another way is to increase the wage, both of which should lead to a better economy, the circle of good economy.
How are they viewing the strength of the yen right now?
158, yeah. But from a perspective of equity markets, actually dollar yen below 160 is okay, manageable. Corporate assumption for 26 FY, dollar yen is 152 with conservative bias, and 150 is last year's average. So our break-even dollar yen for households' real income growth is 160. So, of course, Takaichi administration's fiscal expansion continue yen weakening pressure, but we also heard last month that government hint a potential GPIF investment shift, and we saw Japan-US joint FX intervention. So such flow of funds policy would be some supportive factor to reduce the further yen weakening pressure.
Where's Jp Morgan seeing the yen year-end?
Yeah, 164, no change year-end.
Okay, so, despite everything that has happened with joint intervention.
Yeah, from now, still, 4 months from now. So, but there is also, risks in a short term. Such government address should keep yen a bit strong.
Yeah, not to mention, of course, BOJ decisions as well. When it comes to these businesses, we talked about the strength of the semiconductor side of things, and we talked about the broadening of it, machinery, other sectors like banks as well. Are there any outstanding to you that you think have more potential going forward?
Yes, I overweight banks from structural perspective, like for medium term, time horizon. Some investors see the bank's valuation, current PB 1.5 times, PE 15 times, already pricing to BOJ rate hike. So what else? But my view is, long growth is one thing. This is the start of the cycle of strong growth investment. Another thing is potential deposit shift. Deposit shift makes banks who has resilience to deposit beta, long-term rates rising, or upgraded cyber attack can be winner. Through this process, I think deposit yield, loan yield will be normalized from a level under deflationary economy. That is catalyst that has not been in EPS or ROE. So I think further upside in medium term will be justified, can be justified.
I mean, all three mega cap banks have beat their estimates this quarter, right? So it seems to be almost consensus that there's more upside for financials. But Ria Nishihara, it's really good to have you with us, Chief Japan Equity Strategist at Jp Morgan Securities.